So let's get started. First of all, welcome everyone. Thank you for joining us. We appreciate you setting aside the time today to hear from our amazing panelists and learn more about what's happening and how deals are getting done in 2022. So I want to start off by doing a quick round of introductions and introducing our panelists. To start, I'll be our host for today. My name is Nevin Raj, and I'm one of the co-founders of Grata. And with me today, I have two great panelists. First, I'd like to introduce Arra, who is a partner at Craft Ventures. Craft is an early stage venture firm who actually invested in Grata and led our Series A. I'll let Arra do her quick introduction.
Hey, thanks, Nevin. It's great to be here. Like Nevin said, I'm a partner at Craft Ventures. We are investing in early to growth stage companies in SaaS and marketplaces. I've been with the firm for 3 years. Before this, I was head of operations and strategy at a venture-backed startup called BuildZoom, and I started my career at JP Morgan in investment banking.
Thank you, Arra. Today, Arra brings the perspective of early stage and growth stage investing to the table. And we also have Reed Phillips, the CEO of Oaklins, DeSilva, and Phillips. And I'll let Reed introduce himself and share a bit about his background.
Thank you, Nevin. Hi, everybody. I am an investment banker, and our firm specializes in certain segments within investment banking that include media, marketing, information businesses, and more these days, software and technology. We started the firm in 1996. We have 25 full-time people, and we're part of an international organization called Oaklins, which has 850 investment bankers in 45 countries.
Amazing. And today, Reed brings us the perspective of the middle market. So we'll get two different angles on investing. And the theme of today, and we've heard a lot about the state of the macroeconomy, the uncertainty, how are deals getting done. We're not here to make predictions. We're not here to talk doomsday with you. We're here to talk solutions and how deals are actually getting done in 2022. The demand for deals is still high. There's a lot of dry powder out there. Baby boomers are retiring. Smaller deals are less macroeconomic sensitive, and thesis-driven investing is on the rise. So on that note, excited to hear from Arra and Reed. And I'll start off with the first question. And the first big question is, we know things are changing in 2022. Macroeconomic environment, is changing. How is this affecting your deals? So let's start off with Arra. How's this affecting the growth segment of investing, and what are you seeing out there in the economy?
Yeah, I would say, the first big obvious elephant in the room is that valuations have come down. But I think more importantly, you've seen investors take their time with diligence. So I've seen processes be, in general, less rushed. Investors are paying more attention to things like unit economics and really scrutinizing the health of the business and the quality of the customers, paying attention to things such as burn multiple, which is a measure of capital efficiency. So how much are startups burning relative to the net new ARR that they're generating in a given period of time? So we're seeing sort of the return of emphasis on unit economics and making sure that we're making wise investments.
And Reed, the middle market's a little different. EBITDA generating profitable businesses. How are things changing in 2022 from your perspective?
Yeah, absolutely. I've been an investment banker for more than 30 years. I've been through a number of downturns, and most of them are gradual, unlike when we had COVID or 9/11 or even the 2008 financial meltdown, where you pretty much go off a cliff in terms of doing deals. But more typically, when there's a downturn, it takes 6 to 8 months to kind of fully be felt by middle market M&A. And that's what we're seeing right now. We're seeing concern on the part of the buyers and sellers and more caution, but we're also seeing most of the companies that we're in market with delivering excellent results still. They haven't really been hampered yet in terms of higher costs, and they're not seeing lower revenues. So, for the most part in the middle market, it's almost more about the fear of what's coming than what's already here.
It's interesting, Reed. I'm curious, I'd love to learn more about your general strategy, how you advise your clients. I know you serve a lot of financial sponsors as well as strategics. How do you generally advise them, and how has that changed, if at all, in 2022?
Yeah, well, a quick example would be looking back to COVID, and we did work on deals during COVID with companies that actually performed better during COVID than they had previously, as well as companies that performed much, much worse. For example, almost any company in the events industry stopped producing events and really struggled. So what happened is that some of those companies that decided to do M&A in the last couple of years have done so with earnouts, because they basically say to the buyer, I believe the business is going to rebound. I'm willing to bet that over the next couple of years it'll perform better. So I'll take part of the purchase price as the business performs better. And the sellers are willing to do that, of course, because it mitigates some of the risk. So that's also a very good formula for what we see as we're going into the second half of 2022. You may have buyers who are a little bit more cautious than they were previously. They're not, as Arra said, they're not rushing to get deals done as fast as they were before. They're taking a little bit more time and doing a little bit more diligence, and therefore they because their approach is going to be more cautious, they may need earnouts as a way of solving the problem rather than paying all cash at closing. Even today, there was a deal announced last week, the sale of Industry Dive to a strategic called Informa. And about 50% of that purchase price is on an earnout, even though that's a company that's performing really well and growing nicely.
That's very interesting and very insightful, Reed. Appreciate that. Ara, how about to you in the growth sector? How has your strategy, your general perspective changed? Has it changed in 2022 relative to the past?
Yeah, honestly, I'd say my general perspective on investing hasn't changed. We're always looking for the best companies and always believe that really great breakout companies are formed and in recessions and ones that can thrive in recessions. I'd say that for me, I'm always looking for products and companies that are painkillers, not vitamins. So tools for customers that are need to haves, not nice to haves. Um, and so I'd say from like a general craft perspective, we've always been more metrics focused versus narrative focused. We're looking for proof points. We're looking for stellar customer references and things that are reflected in the metrics. So I'd say in general that hasn't changed this year.
So let's talk. Both of you have done a bunch of deals in 2022. It's been a different environment in the past. Let's talk about a specific deal. Tell us about the deal. How do you get it done? Reed, let's start with you.
Sure. Yeah, one of the deals that we just closed recently was the sale of Advertising Week to Emerald X. What was interesting about this particular deal is that we found coming out of COVID, I should say hopefully coming out of COVID, I'm not sure we've entirely come out of it, but kind of a reemerging and buyers being more active and deals getting done, which started about the time of the vaccinations a little over a year ago. A lot of companies were approached by buyers, and that was the case with Advertising Week. They were approached by Emerald X, and Emerald was very interested in acquiring Advertising Week. And So we were hired while Advertising Week had a buyer already at the table, already ready to discuss a potential purchase price. So when we were brought in, it wasn't to like scan the marketplace and come up with and talk to 100 different buyers. It was really to focus on getting a deal done with Emerald X and really vetting the buyer to make sure that they could bring the capabilities to Advertising Week that they were looking for in a partner, because the objective wasn't to sell 100% of the company today. It was to sell part of the company today, but over the next several years to be for the owners of Advertising Week to continue to be rewarded by the growth of the show. They felt there was a lot of growth potential with regional events, international events, and they've really embarked on a strategy of providing content and learning experiences for their audience. So all those were growth initiatives. They wanted the partner to buy into those, to also commit to funding those so that the business can become much larger in the next 3 to 5 years.
It's interesting. And the theme I'm hearing is all about this long-term mindset, where if you make a bet, it's going to be not a year, not 2 years, it's going to be 3, 5, 10 years. And therefore aligning incentives to that mindset is what helps you clear a deal essentially between buyers and sellers.
Yeah, absolutely. And in some cases, you certainly have cases where a seller says, "I want to." We have one right now. We're hoping to close the deal in the next 30 days. Our seller said, "I want out. I want to sell the business. I want the buyer to take it over and run it." And that affected the decision making on the part of that seller, because he really went with the deal where he could walk away. The buyer knows his business already. He had other offers where he needed to stay on for a couple of years, could have made more money by staying on the earnout, but he chose to walk away. Because he's felt he's getting enough cash at closing, and he was ready to retire in this particular case.
That's interesting. Yeah, it's not categorical. It's clearly seller dependent. All right, how about with you? Tell us about, you've done a bunch of deals this year, even at the turn of 2021. Tell us about a specific deal and how you got it done.
Yeah, I mean, as you pointed out at the start of the show, we are really super excited and grateful to be leading your Series A, which we announced together earlier this year. So, like I mentioned earlier, we have like a really high bar. We're looking for A+ teams, so founders whose skill sets complement each other, glowing customer reviews, and with Grata, you had those, you had great metrics, and there was a clear gap in the market that you're addressing. There was some competitive pressure to get through diligence quickly, but luckily, we met each other, I want to say 2 years ago. So already gotten to know the space, got to know you and Andrew, got familiar with your product. So that definitely helps speed things along. And, deal making in venture markets, it's as much art as it is science. So you have to, as an investor, you have to be able to manage relationships with the founders, relationships internally with partners at your firm, and be able to convey why you're excited about a deal and why you guys should do it. So I'd say it was definitely a great experience and really speaks to more of the fundamentals of venture investing, which is getting to know companies and founders earlier on. I'd say when I'm speaking to companies, I'm not necessarily looking for immediate gratification with a deal. Sometimes it takes, a couple rounds for it to be the right timing for both parties to work together. So definitely paid off in this case.
Thanks for the kind words, Arra. I want to dive into one point that you mentioned around deals getting more competitive. We're all seeing more investors, whether that's early stage all the way to late stage, because of the more dry powder approaching companies. And Reed, you also mentioned that your deals have been approached by multiple buyers. Arra, you talked about building long-term relationships and not seeing really the immediate returns until in the Grata example, close to 2 years after. Reed, what are you seeing in the middle market? Are the deals you're seeing, how are buyers getting a competitive edge?
Yeah, good question. What the thing that I am seeing that's changed since the beginning of COVID is that we're finding buyers to be more aggressive in approaching potential sellers, more so than in the past. In the past, maybe they waited for investment bankers to bring them opportunities, but they're actually going out and aggressively talking to companies. So it's pretty rare right now when we take on a new assignment that our client doesn't say, oh, I've already been approached by 5 buyers just in the last 6 months. So those buyers become part of the sales process. But that's the environment that we're in right now. That may change if we're seeing a slowdown in the economy, if we're seeing inflation becoming more of a factor. But as of right now, we're still seeing buyers actively knocking on doors of sellers and saying, can we have a conversation?
It's very interesting because you're right. The old method was, hey, I'm going to wait for the deals to come with me with relationships and others. But now it seems that that proactive strategy is really pervasive in the middle market as well as in growth stage and early stage. Arra mentioning the 2 year relationship with founders, as well as each one of your sellers, Reed, coming up with 5 different conversations before they even run a process.
Yeah, exactly.
So then how can deal makers get more creative when it comes to sourcing deals? If their peers are talking to the same companies, what advice do you have for them to build an advantage with sellers?
That's also a good question. You know, a lot of it is building a relationship, and in some cases, you don't have a lot of time to build a relationship because a client may come to you, a prospective client, and they may say, "Oh, we're talking to 5 other investment banks along with yours." So you have a very short window of time to develop a relationship with that potential seller, maybe you know 30 to 60 days. What you want to do is try to differentiate your firm and your capabilities from the other investment banks that are pitching for the deal. The way we typically do it at our firm is all of us are former operators before we became investment bankers. So for the most part, my colleagues have deep understanding in the industries that we're in. They know a lot of the people in the industry already, and they know how the businesses work. So that's very comforting for entrepreneurs who have started businesses to hear that we really understand what they're doing and appreciate what they're doing. Same thing with strategics. It's less of a factor with private equity. With private equity, if you want to have an advantage as an investment banker and hope to work with them, the key is to show them a lot of deals and hopefully get another deal done with them at some point so that they feel they're repaying the favor of having worked with you on a previous deal.
All right, I know Jeff and David are also operators, so are you and many others at Craft. What's your perspective on how investors build that competitive advantage?
Yeah, actually, everyone at Craft is a former operator, so that's the foundation of our fund. Um, Jeff and David were very successful founder CEOs, and I think it certainly helps us be able to empathize with founders that we're talking to, but also develop a deeper understanding of like the day-to-day operations and what happens at startups and be able to better advise them and better relate to them and the other teammates. Um, Otherwise, I think some things that we like to do is put out a lot of content and democratize access to information around what we're looking for, tools that companies can use to track their own metrics. So one example is we have this tool called SaaS Grid, and we basically productize the SaaS metrics that we run on every SaaS company that we look at. So putting out this type of information, as well as getting on these webinars and social media platforms and talking about advice for founders, but as well as like tactical things that they can do and what we're looking for. I think really helps us stay top of mind and develop that trust and relationship even before a deal's about to be done.
That's a great point. Actually, I want to emphasize that because both you and Reed brought that up. It sounds like the key is being proactive and building relationships. But if you have to build a relationship in a shorter period of time, having content out there, having operators at the table, providing value to the founders and entrepreneurs you're talking to seems to accelerate that conversation. It seems like both of you agree on that. And I think that's a point that a lot of people in the investment world may miss. Maybe having regular check-ins with a company and thinking that's building a relationship when you can do it faster if you get deep on a sector, deep on a business model. And
Yeah.
actually, to that point, we did a little research and found that, interestingly enough, fewer than 5% of private equity firms and investors identify as pure generalists. Everyone's specializing, whether that's sectors or we hear the theme thematic or thesis driven investing. I think it's related to this point of building expertise, but we'd love to hear, Arra, to start your perspective on thematic, thesis-driven investing and how this impacts your role in craft.
Yeah, I mean, having a thesis and areas where you focus as a fund or as an individual really allows you to spend your time in a more focused way. So rather than trying to boil the whole ocean or reach out to every startup in the universe, it helps if you're focusing in on a particular area. Also for me, I know I learned so much just by talking to founders in a given area day to day. So constantly accumulating that knowledge, at a high level helps to see, trends and things being formed that way. And that I've seen helps us win deals. Founders want to be in a portfolio of other like-minded founders. So it's not just about the relationships between investor and founder, but also like founder to founder underneath our hood. And I also think that just sourcing and doing diligence gets easier the more knowledge you have in the space, so you can get that done faster. But another thing you brought up on content and how investors are putting out content, I also see startups putting out content. It helps us do our diligence, when companies have, customer reviews on their websites, or they're constantly posting webinars or seminars with their customers. And it's like you're collecting that customer feedback in advance before ever meeting the companies.
Very interesting. So you can almost go into a process knowing most of what you need to know that you would have had to do, where someone who maybe doesn't know the space as well has to spend weeks doing.
Yeah, exactly. So I think it helps companies get more customers when they have glowing reviews, but it's also something that investors are paying attention to.
And Nevin, I was just going to add to your point that some of the private equity firms, most private equity firms, are becoming more and more specialized. That's actually a good thing for us because it's easier for us to then target the right private equity firms with the companies that we're selling. If the firms were more generalists, then we would go to firms, but they would say, oh, gee, that's not for us. It's not in our sweet spot. But now we pretty much know exactly what the sweet spot is because so many of the private equity firms have moved towards becoming more specialized. I was speaking with a private equity investor about an hour ago, and he was just extremely focused on a couple of different markets and felt that gave them a big advantage on closing deals because they know the space they know the space really well, and they can move faster than their counterparts.
That's interesting that you're seeing that too. And Reed, what happens when we've seen more often than not, a firm will build a thesis, go out and maybe exhaust that thesis because there are only a limited number of companies in the space. What happens then? Do firms typically stay in the space, or do they move, or how do they evolve their theses over time?
Yeah, they would typically move maybe into an adjacent space that they became aware of while they were focused on the one space, but they definitely are moving and adapting constantly.
That's great. So I want to make sure we have time for our audience to ask a few questions. So I want to open the floor up to anyone. You can put your questions in the Q&A, and as they come in, I will read them off to Reed and Arra. And you can also direct them at Reed or Arra if you'd want. All right, looks like we got one from the audience. It looks like Jason is raising his hand. I don't know if we can give Jason the mic or if he wants to type it in the Q&A. All right, we have a couple other ones coming in as well. Okay. So, question from someone in the audience. How is the growing strength of the dollar affecting deal making?
It obviously it gives buyers that are buying in dollars more clout. So the firms that are in the U.S. that are buying internationally can buy more efficiently in Europe than they could have 6 months ago. So the dollar's just that much stronger. Whereas the opposite's going to be true for European buyers and maybe even buyers in the UK, where they're not going to have the advantage that they've had previously when they look at deals.
Or how about you? Do you see any cross-border deals and the strength of the dollar affect that?
Honestly, I'd say, mostly focused in the US, so that hasn't impacted us so much.
All right, next question. This one's for Reed specifically. Reed, how do you suggest maintaining relationships with potential acquisition targets who initially express that they are not interested in selling?
That's obviously a very good question. The most effective thing I've seen done by buyers is just to continue to stay in contact with those companies, because at some point those companies probably are going to decide to sell. And if you are in touch quarterly and perhaps take the owner to lunch and are curious about the business and show that you're really interested, that will give you a leg up later in the process, when later down the road, if the company enters into a process or decides to sell.
So as a good summary, no, maybe not now, but it could be in the future.
Yeah, always take no as not now.
This one is for both Ara and Reed. Question is, what are some macro trends that will impact the market? For example, recession, difficulties with digital ads, volatility around crypto. It sounds like, what do you believe are some of the key factors that investors should be looking out for?
I think in general, in a recession, a lot of things get easier from the perspective of, if fundraising gets harder and, there's less competitors coming into your space, it should be easier for you to get new customers and keep growing. Obviously, a recession might also impact your customers' ability to pay for new tools. So that's where I talked about earlier, being a painkiller, not a vitamin. So if you're a nice to have, customers will always be looking for the next best alternative. So making sure that you're far beyond that and worth the spend.
Yeah, and I would add that buyers in this kind of environment where things are changing and everyone is anticipating that the market won't be performing as well as it has, buyers get nervous that if they buy something today, they may be overpaying for it. So that's why they slow down a little bit, get more cautious, because they certainly don't want to 6 months down the road feel like they've overpaid by millions of dollars for a business. It's exactly the same in the housing market. If you buy a house and you happen to buy it at the peak, and a year later your house is worth, 10% less than it was, you feel like you should have waited and you should have been more cautious and a little bit more conservative perhaps on how much you paid.
Our next question is, I appreciate the investing in painkillers, not vitamins approach. Is this part of an analysis to determine whether a company has a feature, product, or platform? I think that was directed to Arra.
Yeah. I'd say that, you can have a feature of a product that's a painkiller. So not necessarily looking to answer that question. It's more like, um, if if you're like building a tool and say it's a collaboration tool, for example, if people can get the same job done a little bit messier but for free in like a Excel spreadsheet or a Google Doc, then I'd say like your product feature, whatever, might be just a nice to have if you're like merely organizing that and presenting it in a much better way. But if you're providing something of proprietary value that the customer can't get anywhere else, then I'd say that's definitely more of a painkiller and something that's more likely to thrive in this market.
I'll direct this one to Ara as well to maintain neutrality. But someone asked, what is Grata's advantage over SourceScrub, for example? I guess per your diligence, what did you find?
Yeah, I think Grata I find to be much more tech first versus Source Scrub. So, one thing that's true in a lot of different sectors is utilizing human effort to do work manually. So, and that's great and works in many cases, but it's not always a venture backable, scalable business that can grow much more quickly. So Grata using data, machine learning to really pull data in from every source on the web is a much more effective way of bringing information to the table in a scalable way, but also presenting new information that is tough for humans to find manually.
Thanks, Ara. And we'll follow up directly with whoever asked that question as well with more details.
Send them a sales deck.
This one looks like it's for Reed. As a prospective lower middle market buyer, how should we position ourselves heading into the first half of 2023, i.e. wait to close out this year or move transactions closings to next year?
Well, I think you have to weigh a lot of things. If you move transaction closings to next year, you may lose out on the deals because there may be other buyers who will acquire them now and feel confident that they can buy them now at the right price. So that's always tricky. So I think you have to, what we are finding with buyers now that we haven't seen in about a year and a half is in a couple of cases when they're bidding on companies we're selling, they're stepping back and saying, with all the macroeconomic issues out there right now, I need to take the next 30 to 45 days to look hard at my company and make sure my company is continuing to perform the way I expect it to before I go out and do this acquisition. So I'm going to have to hit pause and wait a little bit. So if you're in that situation, of course, that's exactly what you should do. But if your company is performing really well and you don't see any signs of slowdown, I think you should charge ahead with acquisitions at some point that will differentiate you from other buyers who are going to be more cautious.
Great. Reed, another one for you as well. What impact is inflation and recession having on your book of business?
A lot of it right now is perception. It's everyone's looking around and saying, gee, we're headed, we definitely are seeing higher inflation. We're probably heading towards a recession. I may not be feeling it yet, but everybody is talking about it, so I better start thinking about it and be more aware. But as I said earlier, a lot of the companies that we're interacting with, we've at any one time we're in the market selling 20 companies. They continue to perform. They're continuing to show good results. We don't have anyone yet complaining about less demand for their products and services or substantially higher costs that they can't manage.
And that may also have to do with the nature of the businesses that you represent, Reed, right? In tech, media.
Absolutely, absolutely. Yeah, yeah, it does.
This one's for Arra. Arra, has Craft found in-person events to be essential to sourcing / helpful from a lead gen perspective? And this is actually related to the next question around digital business.
Yeah. Actually, my view is that I've become more productive since everything moved over to Zoom. And from what I've heard from founders, it's also become more of an efficient process to at least start the fundraising conversations over Zoom. I remember when we were in person and every meeting was at least an hour. You factored in travel time and getting in and situated. You could only have so many meetings in a day, and moving to Zoom has really made more of my time. So I can take more meetings in any given day than I could before. That said, I think for relationship building purposes, do you need to meet in person? No, I think I've been able to get along with people and get to know them over like many Zoom calls. Some people are just geographically far away, but if somebody is local or if I'm traveling to their city, I always think it's nice to meet up in person and have a coffee or lunch and, get to know them in that setting. But overall, I don't think that you need to travel to make relationships. In fact, I think one challenge is how do you get in front of people? So going to a conference at least maybe guarantees that you're in the same room as people that you want to meet. But I think that's where, on my TikTok channel, I try to give best practices around like writing really good outreach emails and getting the attention of the person that you want to reach and getting a response from them.
The next one is actually pretty closely related, so I'll kick this one to Reed to start. How much digitalization, data, business development, digital marketing, etc., do you think will define deal sourcing in the coming years versus relationship-driven deals?
I think it'll continue to be a mix of both. I think both are very, very important, but we're constantly finding that we need to have more advanced technology. We need to be able to move faster and smarter, and so any tools that make that more available, or make those capabilities more available to us, we're certainly in search of. So I think it's a balance between those two.
And Ara, do you have any further perspectives on that?
Yeah, I think using tools to make sourcing much more efficient is definitely an advantage. There's a huge universe of startups, and being able to narrow down, what each one does exactly to see if it's a good fit for your thesis and your fund, what stage they're at and any indicators of their growth, being able to pull that data is a huge advantage.
All right, next two are for Reed. This one for you, Reed, is how do you approach a situation when you're aware of a buyer's, could be strategic or PE, intention to penetrate a market? How do you approach potential targets for said buyer in order to generate a sell side mandate? So it sounds like the question is around buy side advisory and how you go about working with clients that way.
We do sometimes get phone calls. I had one about a week ago where the person I was speaking with is a buyer, not a seller, but he was telling me what he wants to acquire. and was actually encouraging me to go after companies that then I could turn around or his thinking was, he's a former investment banker. He was at Goldman Sachs for a long time. So here's what his thesis was. Not that I agree with it 100%, but it was, hey, go tell such and such a company that you got a buyer who you know of a buyer who's interested in buying their company because I'm particularly interested in these industries. You may get the sell side mandate, and when you do, bring the deal to me, and of course take it to other buyers that you might also show the deal to. So that's one approach. We don't really, we typically don't do that that much because we just already have so much expertise in the market that we don't feel we need to do that. More likely, we would be having a conversation with a seller, and we would say, here are 15 or 20 buyers that we think are appropriate for your company. We wouldn't put such emphasis on one prospective buyer.
Also, Reed, question for you. What's your initial process for finding strategics that are not your typical buyer? I think this has to do with you get a sell side mandate. They're the obvious Fortune 100, Fortune 500 companies that come to mind, but how do you find these other strategic buyers?
Yeah, very good question. It really just takes thinking about through the business and thinking who else might be interested and coming up with groups that may seem at on the surface level to not be a fit, but there may be something that makes the business a fit. So we've had a lot of cases where a perfect example is when we sold Harbor Picture Company, the largest independent film production and post-production company in New York City. The thought at the beginning was, well, more than likely we'll sell it to another post-production company, whether in London or LA, wherever they may be. But one of my colleagues, John Kaiser, who specializes in working with advertising agencies, was aware that advertising agencies have that capability embedded in their companies. They try to provide those services, but a lot of times they're not successful because the folks that are doing advertisements want to have really professional level production work done, not the work that was being done by the agencies. So in the end, we sold this company to Publicis, one of the world's largest holding companies. And Publicis put Harbor Picture together with their own internal business, and they became, over the next 5 years, much, much more successful because all of a sudden they could say, well, Harbor Picture does all the Ron Howard movies, and it does this, it does the Netflix and Amazon movies. So of course they would be great to work on your commercial.
That's interesting. So it sounds like there are the obvious buyers, but they're also the ones that maybe have a gap in their portfolio where they're building out a strategy and you can be the next pillar in
Yeah,
the direction they're going.
exactly.
All right, one more. I think both of you can answer this one. This one is about multiples. Do you think multiples will stay stronger with firms that have called capital or see more of a decrease in multiples with firms that are structuring with more debt now and into Q4?
I think that's for you, Reed.
Yeah, sure. I mean, I think we're seeing multiples hold up right now. Like there were a couple of deals in the marketplace that traded at, one was at 14 times EBITDA, another one was over 21 times just in the last 2 weeks. But I do expect to see softening in the next 6 months on multiples. I think we've been at a peak for about a year. So I think what may happen in the next, say, 6 months to a year is you won't have high quality companies coming to market as they have in the last year. You'll start to have some mediocre companies that'll pull multiples down. You'll have private equity buyers who want to use more debt than equity, and the private equity investors also are, I think, going to start to be a little bit more conservative. So I believe that multiples will come off of the high that they've been on for about the last year, though they're not going to drop considerably, but they'll come off of, I've seen averages that are around 12 times EBITDA.
And do you think that's impacted by debt at all?
Will that be affected by debt? Or,
Yeah,
um,
more debt.
I mean, usually what happens with the, debt is that borrowers will borrow as much as they can, and feel comfortable that they can. But as the interest rates go up, more than likely the multiples will have to come down to adjust for the higher interest that they're paying on the debt that they're borrowing.
So that concludes the questions we asked, and really appreciate the audience for all those amazing questions. Before we end today, I would love to get some closing words from both you, Reed, and Arra. If there are one or two takeaways from today that you want the audience to take home and really internalize, what are they?
I think there'll be great companies that will come out in this, economic downturn time. I think if companies need to raise, they of course should. Otherwise, even companies that maybe raised a lot of money at the peak highs of last year, they should really pay attention to their burn multiple and really like scrutinize their own metrics day in and day out and make that money last.
Yeah, and I think that companies, will continue to perform well enough between now and the end of the year, particularly in the middle market. And they should, what we're hearing from companies is that they still are growth minded, and a lot of times they need the acquisitions to fuel that growth. So I think there will still be a lot of activity, both in M&A and in growth capital.
Great. Well, first of all, thank you so much to our panelists for providing so much great insight and thoughtful responses to all of the questions. We appreciate your time today, and we appreciate you both being Grata users and customers as well. And thank you to our attendees. There were a little over 60 who joined today, for your time and for listening in and asking great questions. We'll share the recording with everyone so you have this on file and you can rewatch certain parts of it. And if you have any questions, feel free to get in touch with any of us. Thank you all and have a good afternoon.
Yeah, thanks for having me.
Yeah, thank you, Nevin.